Yeah, welcome all to the third edition of In the Room with Nate. My name is Steve Backhouse, and I'll be your host for today. And with me, I got Duane Cable. How are you, Duane?
Hey, Steve. Well, in yourself?
Good. Welcome. Before we get going, I mean, I think just to give some context to what these sessions are about for the audience. So we started these towards the end of last year, and they're interactive webinars with asset managers from locally and actually also globally. And today we've got Duane from 91. I'll give an introduction to Duane shortly. But the idea is actually they called in the room because the idea is that we actually go to the asset managers kind of office, sit in their businesses and get a sense of kind of how the look and feel and the culture of the business as well. And obviously at the moment that's quite difficult. So now we are literally in our rooms of our houses. So as I said, I think the idea of these sessions are interactive. So it's a conversation. There are no slides. I will ask Duane a couple of questions, and then please, the audience must also please ask questions via the Q&A tab, which is found at the bottom of your Zoom screen. I'm sure you're all quite familiar with that now. The chat is disabled. Just use the Q&A. So then I'll just quickly introduce Duane. So Duane is a portfolio manager in the 91 quality team, and he heads up the South African quality business. He's the co-portfolio manager of the 91 Cautious Managed Fund. Importantly, I think it's in context of the 91 business. Duane's views are Duane's views and of the quality team, not of the issue of the broader business, because obviously there are different types of investment businesses inside 91. Duane is also a father of two, an avid cyclist, and has spent quite a lot of his career working abroad in London, Cayman Islands, and New York. So quite some good international experience. Cool. So just I always remind myself of a couple of things. So one is CPD points. Everyone wants to know what the CPD points process is. So you'll get half a CPD point for the session today. And what we do is we send after session, we send a thank you email to all the attendees. And on there is a little assessment that you need to complete to achieve your CPD, half a CPD point. And also we will also send I think a recording of the webinar, as well as a slide pack, which from 91, which will probably help with some of the context. Okay, so I just see, so we've already got a first question, which I'm not going to start with. Dori, we are going to get into it, which is great. Okay, so then just to kick off, so Duane, I mean, we're now into, I think, week 4 of lockdown, hopefully nearing the end. I think there's an announcement of some sort this evening from our president. I mean, how's it been going for you from a kind of a personal, professional, work-life balance, managing the family and all of that?
Thanks for that, Steve. I mean, again, it is quite fascinating because if you look at, I'd say firstly on the personal side, I think I'd be lying if I said it hasn't been tough. I mean, again, it's the one where you correctly mentioned this is the 4th week of lockdown. And for those of you who know me knows that I'm an outdoor person by nature. I mean, I love cycling. I love being outdoors. It really helps with my ability to think and just frame a lot of decisions I've got to make. So being locked up inside is actually quite challenging. I mean, I was joking with my team this morning on the morning meeting that I sort of put on my suit for the first time this morning in 4 weeks. And everything is feeling a little bit tighter. And if you go back to the picture that that you guys had up at the start, sort of shows the fighting fit Duane relative to one who's a little bit rounder now. So that clearly has been tough. Working with the family at home, with the dogs and the kids running into the office, that clearly is something that I've had to manage. So that's the personal side. But I think importantly on the business side, it's actually been a lot easier, where it actually really has been business as usual. You'll know that the quality capability has multiple locations. I mean, we've got teams in New York, in London, and in Cape Town, and we interact regularly with telepresence, Skype, and often work remotely. So the lockdown has actually had no impact in terms of how we run and how we manage the business. We've got access to all our systems. The team is still in contact. We're still following the markets. So from a client perspective, it really is business as usual, and just more on the personal side, having to manage some of those inefficiencies that we all have to in our daily lives.
So I mean, I think that's an important point, because again, you know, if you're an advisor and you're looking after your clients' well-earned investments, it's important to know that actually nothing changes from an investment point of view. And to reiterate that, because again, I mean, I think some people are actually asked, and not necessarily in our industry, but like some industries, they're stuck at home doing nothing. They can't operate. But from our perspective, importantly, it is business as usual. Yeah, absolutely. Yeah, I mean, one thing, again, I mean, it's been an interesting couple of weeks. I mean, when we first started chatting, which was probably about 10 days ago or so, I mean, the market was almost 30% down year to date. There's some serious volatility. The rands are kind of 18 to 89 or so, I think, when I last checked earlier today. And I mean, how is, I mean, obviously also then the market's rebounded. I mean, it's now, I think overnight for yesterday it is about 14% down. So, you know, how is the kind of the cautious managed fund stacked up during this time? And do you feel your process has been shown to be robust during this time?
Thanks for that, Steve. I mean, again, I think the important point to mention is, again, I think the importance of having a team that has been experienced and a process that has been tested, not just in the short term, but over multiple cycles. And I think where we are fortunate within the quality capability is that we've got quite an experienced team that has managed these portfolios through numerous cycles. So many of us managed portfolios in the global financial crisis and have seen this level of volatility. But what we've seen since the global financial crisis has clearly been a period where there's been relative stability and low volatility. And we always mention to clients in terms of how we were constructing the portfolio, especially in these low risk mandates, that people should not forget about risk and about thinking about the downside. And I think where we are pleased with our performance is if you look at what's happened in March and the extent to the drawdowns we've seen across the sector, that on both a rolling 12 and 18 months, the cautious managed portfolio remained positive from an absolute return perspective, whereas a number of our larger competitive funds were actually negative over those same periods. So I think we once again being able to demonstrate to our clients that when we think about these portfolios, we are able to not just think about the upside, but also think about the downside. And I think this was demonstrated in the cycle in terms of our investment philosophy, process, how we think about risk, and how we construct the portfolios.
I mean, what we've also seen, I mean, we've actually got a second question on oil. I promise you we're going to get to oil shortly. Just lastly on that point, you've also seen a lot of clients. We've seen a lot of clients run to cash. Now, I mean, it's an honestly, you talk about the risk. I mean, the risk that you're in, and the types of. At the same time, you can't be running to cash, because actually the reality is your real return is going to be negative. And we got 100 basis points cut in the rates last week, which could impact cash returns. I mean, again, it's the importance of being invested. I mean, can you, just for the listeners, kind of reiterate that point?
I think that is a very important point, and something that I've been communicating to clients, not just recently, but over a number of years, because I think where we were from a unique perspective from South Africa is that your growth assets, and when I say growth assets defined as equities and property, locally just have not delivered inflation beating returns, not over the short term, but we're now talking over a 5-year period. And you look at what you could get on the average money market fund, I mean, you're talking something close to 7%. So you were getting attractive returns in cash, and your clients were saying, we can't stomach this volatility, so we'd rather want to be hiding in cash. And while that would have been fine historically, I think investments is always about forward-looking statements. And I think the important points I would want to highlight is we flagged for some time that we expect interest rates to come down. So where you're seeing now the returns on those cash funds, or the new norm is going to be sort of looking closer to 4 to 5% rather than the 7% that investors have gotten used to. And in a world where we're still facing inflationary pressures, I mean, we know what's happening to electricity, we know what's happening to healthcare, education. Those things continue to accelerate well above your CPI target. So if you don't have exposure to growth assets that can give you that, you essentially your capital's going back in real terms. So it comes back to that concept, and I think it's an important concept of having a balanced portfolio. And I think what investors have got to do is have that balance between offense and defense, where you've got that defense in terms of having some cash in the portfolio that gives you the ability to participate and take advantage of opportunities when they come along, but also have some offense in terms of taking advantage of opportunities and having growth assets that are attractively valued. And I think that plays perfectly into how we've constructed the cautious managed portfolio that gives you the elements of defense and offense to be able to generate that inflation beating returns over the medium term while seeking and giving capital protection in the short term.
And also, I mean, there's also been a lot of studies done in terms of if you miss the corrections, so the best days in the market, I think the 5 best days in the market, you actually don't get the growth. And a great example would have been is if you 2 weeks or 10 days ago, if you had taken all your money and put it into cash, you would have potentially missed that kind of the correction we've had over the last little while. Okay, so let's get into the conversation about from oil. So again, so this was literally at 2 minutes past 11 I think I'll still do my intro. This question came from an anonymous attendee. Duane, what do you make of the current negative oil price?
Yes, I mean, again, this is the one where, I mean, apart from cycling, I mean, I live and love the markets. I mean, I follow the markets at all hours of the morning and at night. That's sort of my way that I relax. And I mean, last night, throughout the chats, everything on TV, everyone was speaking about oil. So, I mean, I'll make a few points which I think are relevant. So firstly, when you think of for the portfolio, so currently the cautious managed portfolio has got no exposure to oil, and we don't have exposure to Sasol. So from a portfolio perspective, this is one that does not impact the fund because we don't have exposure. I think importantly then, if you now go to what's happening, I think there's clearly a technical issue, which I would like to explain and unpack, but to give you the brief insights into what's happening. So what's happened is in oil, you've got essentially two essentially benchmarks, which is WTI, which is the one West Texas Intermediate, and you've got Brent. And the oil that has gone negative is your WTI, which is your West Texas Intermediate. And what's happened there is you've got some futures contracts that are now due that runs out in May. So that comes up this week, and that needs to be actually settled in physical. And what has happened was because there's so much excess supply in the market, no place for storage, that there hasn't been someone on the other side of the trade to be able to actually take that oil, to take physical possession for storage. And that has resulted in those futures actually going negative. I think the important point, what this shows, and I think the message that people should take away from what we've seen is just the clear evidence that there is, if there was any doubt in anyone's mind, I think what's happening now clears that up in terms of there is significant overcapacity in the oil market, not just in the US, but globally. And the fact that you can only store, and storage capacity for oil is not infinite. Those storage units are limited. And I mean, it's clear that a lot of those storage facilities are filling up. And so the important message that I take away from what's happened in the oil market is that it A, shows just how weak the global economy is. It shows, secondly, just how much excess supply there is in the oil market. And thirdly, it shows that from a storage perspective, clearly we are near the limits of how much oil can be stored. And that clearly does not paint a positive picture for the outlook for the oil price in the short term, because there's going to be significant levels of volatility given we are in a situation where you've got excess supply, limited storage capacity, and still weak demand.
So on that, I mean, how does, so again, another kind of question leading on for that is, how does this then impact Sasol? So bringing it back to kind of home. So it's the US market more than the global market, but still has an impact on the broad global market. But how does that directly impact Sasol, which again has been in the news a lot lately?
Yeah, so Sasol, that's a good one. I mean, that's one where we currently don't own it in the portfolio. It's one where if you think through our investment philosophy and we think about looking at quality businesses and how we invest, where Sasol struggles is clearly they are sitting with very high levels of gearing. And it's one where that is not a healthy position where you find yourself, where you have got excess leverage on the balance sheet. At current oil prices, they are actually loss-making. So the state of your financial position for the company is actually deteriorating as we speak, which is never a great outcome when you are constrained financially. And so when I look at the outlook for Sasol, I think the outcome is quite binary today, where if oil prices stay where they are, Sasol is in significant trouble and will need a significant capital raising. And therefore, I think there could still be material downside to the Sasol share price, despite how weak it's been. If on the other side, we see some level of oil price recovery, that can clearly be positive for sentiment. And if oil prices go closer to $60, clearly off current levels, there's material upside for Sasol. That, for me, the way that we construct portfolios in the low risk space is not bets that we like to take, because you're either going to lose a lot of money or you're going to make a lot of money. On a balance of probabilities, those range of outcomes are just too wide, that in the low risk funds, that is equivalent to like just gambling. And therefore, we don't find Sasol in the portfolio. So I think it's one where clearly the management team are under significant pressure at this stage and really fighting for the survival at these levels of oil prices.
I mean, so again, one thing, just you talk about quality company. You spoke about Sasol. It's a gearing issue. So you also in your portfolio you talk about how you own quality assets. Now, corporate SA has been or was criticized heavily for having too much cash on the balance sheet for a long period of time. But again, what this couple of weeks have shown us is actually that security has potentially saved a number of businesses. Give us an example of a business that will be struggling over these last few weeks, but is actually absolutely fine because of their balance sheet and the quality type business that they are.
Yeah, so the points you raised there are very points and actually speaks to our investment philosophy. And if you go back through the suite of quality portfolios, so there I would say it's the cautious managed fund, it's the opportunity fund, and the global franchise fund. If you look at how all three have performed relative to the competitors in the drawdown, has shown that those portfolios have been significantly more defensive. And the question that I get from clients is, yes, we understand your process, we understand your philosophy, but why has that been the case? And it's the one where the points that you touch on in terms of financial leverage cannot be underestimated, because the businesses that we own typically don't have a lot of debt on the balance sheet. And what has happened over with, for example, the COVID-19 shuts, is that the economies are shutting down. Many businesses have got no access to revenue, and therefore, if they're still having to pay their staff, are significantly generating negative free cash flow. If you've got too much debt on your balance sheet, or you're at risk of debt coming due and having to renegotiate with your banks, there is a very tough conversation you're going to need to have with your banks to make sure that you get access to that funding. And therefore, you've either got to get that funding from your banks, or you're going to have to go to your shareholders to give additional capital. And that has happened throughout the market. So you've seen a lot of those, which I would call lower quality businesses, having to do that over the last few weeks. None of the stocks that we own in our portfolio have found themselves in that situation, which again just goes to emphasize how important understanding balance sheets and balance sheet risk is when it comes to investing. Then secondly, in terms of understanding those fundamental drivers and what is quality. So you think through two of the big holdings in the portfolio globally as sitting within cautious managed as stocks like Visa and Microsoft. I mean, these are all household names that we know. We look at the metrics for those businesses and what makes them quality, because the point that people often make is beauty is in the eye of the beholder. So why do we see these businesses as quality? Is they generate high returns on capital. They have high margins. They've got conservative balance sheets. And even in an environment where the economies are slowing, their businesses continue. So I'll use Visa as an example. So yes, people are maybe spending less than they do with a tough economy, but people are what we're seeing, some of those structural shifts that's happening to, for example, e-commerce, that is accelerating. So people are spending online, they are buying online, and some of the restrictions that we've seen in South Africa has not been the same restrictions that have been implied globally. So whenever people go online and they put in their credit card number and it's a Visa card, Visa still gets a fee. So it's so if you look at throughout the portfolio, another name that we own in the portfolio is EA Games, which is for any of you who've got kids.
I was about to say.
Yeah, my son's playing FIFA
gaming
all the time, right? So he's playing FIFA all the time. We own the business that owns FIFA, which is EA Games. Gaming is exploding, and that continues to do well. And that business will continue to grow despite what we're seeing in COVID-19. So that is really simplistically what we would say is how we think about quality, the types of businesses that we try to invest in. And maybe the last thing I would say, and what it's probably easy to understand in terms of what we define as not quality, would be, and something that you wouldn't find in our portfolios is, for example, gold equities. And I cut my teeth as a gold analyst in the early part of my career. I mean, they're incredibly difficult to forecast. They generate horrible returns on invested capital. They're poor free cash flow generators. They're constantly going to the market to seek equity. And those businesses are just not high quality businesses. And therefore those wouldn't be in the portfolio.
I just want to get to some questions. So we've got a bunch of questions come through, and I really don't want to ignore them. So the first, okay. So Andrew Clayton's got two questions, and they're both actually around inflation. So what do you think the real inflation rate is? The one you speak of, increases like healthcare, food, luxury food, etc. And then the next question, which I think the EGR does, when we get a measure of this inflation number that growth assets have to be to ensure real returns. So again, you talk about, I think you speak about that real return. We all compare it to what current inflation is and what cash gives us, but we also know that for us in our pockets, inflation is potentially a lot higher.
Yeah. So the inflation question is actually a really important one, and I think it is different globally versus in South Africa. So I'll touch on the global issue first before I come back to the South African topic. And globally, I think people are saying inflation, yes, has been nowhere to be found. And what we're seeing from all this level of government stimulus is that ultimately it's got to be inflationary and there's going to be runaway inflation. So in this crisis, we've seen all the inflation bears come out as they did. And I will just, again, having context and having been in the markets for a time, point people to history and going back to the lessons we learned from the global financial crisis, where we saw significant liquidity, we saw significant support and quantitative easing on the behalf of central banks around the globe. And it did not result in levels of inflation that people had feared. And I think going through what we've seen now, I think we've seen that playbook. So I would just maybe add an element of caution globally when people saying the extent of stimulus we're seeing, it's going to be severely inflationary. I think I'm not of that view, and I don't think we're going to see globally runaway inflation. And I think globally people are actually more battling deflation than inflation would be the first part I would deal with when it comes to global trends. I think when it then comes to South Africa, and I think what is clear in my mind in terms of what is impacting the average investor, and that is whether it be those on the call, your underlying clients in terms of what inflation they are experiencing, my view would be that is nowhere close to the 3.5% to 4% that we've been seeing for CPI. I mean, I look at what's happened in terms of the cost of my living, in terms of kids' education, electricity costs, healthcare costs, your private security costs in terms of your what's happening to your ADT bills. Those things are all clipping at around about 10%. And therefore, I would say, yes, that is not the entire part of my basket. So there's clearly other parts of my basket that I'm buying where you've got some elements of deflation, some maybe closer to CPI, and then you've got some of the big ticket items that I spoke about that's clipping closer to 10. So I think the number is north of 4%, but clearly I don't think based on the basket double digits. So it's somewhere between that 4 to 10% range. What that then does mean for investments is that clearly hiding in cash and the returns that one can get from cash is not going to help people grow their savings over time. So they're going to need growth assets to come to the party. And while growth assets from a global perspective has come to the party, I think for some time we've been bullish on global equities. And global equities, if you look at it over all periods, have given you very attractive real returns for the stocks that we've invested in. So if you look at the performance of our global portfolios within Cautious Managed, the global stocks that we've owned, we've gotten comfortable double-digit returns now in rands for a number of years, and that has given you the above-inflation growth. We think, despite what we've seen in terms of the strong performance in global, our view remains that global equities continue to remain attractive. So we think on a 5-year view, of today's levels, the global high-quality businesses that we invest in will continue to be able to give you attractive real returns based on our forecasts. Then secondly, I mean, we've clearly seen some element of retrace in SA equities and SA property. And while I'm still a little bit nervous on SA property, I think within SA equities, we're finding some quality businesses today where the valuations are more attractive. So our buy list hasn't been this long for a number of years in the SA equity space. And while we have continued to remain disciplined and been strict to our price levels, I think the ability to deploy capital in SA has become easier. So while we're still sitting on truckloads of cash because of our conservative nature, I think our next move is definitely to increase selectively our SA equity exposure, because based on the SA equities that we own today, and some of them that we are on our short buy list, we think the prospects for delivering inflation-beating returns over the next 5 years is actually quite attractive.
I mean, you touched briefly on property, and I know you're underway property, and like as a man on the street, you cannot think that this current lockdown is good for property, and it's in the sense of is actually businesses going to wake up and go, hang on, we don't need these big offices. You know, actually what we need is a bunch of hot desks where guys can hot desks and meeting rooms, so guys can come in, they can drop their computer, they can do some work if they need to, have a couple of meetings. But actually, they're quite happy, and they can work from home. And also, what happened is managers have realised that employees are actually quite good at self-managing themselves and at being productive. So, and at the same time, and I'll use Joburg and Sandton City and as an example, and Rosebank, is that you've seen these massive new office blocks going up, being developed, and what's happened is guys have actually moved out of kind of the older buildings into the newer ones, and there are a bunch of vacancies. So, I mean, this doesn't look good for property in the long run, does it?
No, it doesn't. And I think while people tend to overcomplicate things at times, and I think market participants, maybe I'm often guilty of trying to overcomplicate what is really simple, is the one where, as you unpack where the future is for property, I think it's hard not to be concerned. I think it's important to understand context as well. For a number of years, the property companies had a significant structural tailwind. What was that tailwind? That tailwind was significant growth on the retail side in terms of retailers rolling out additional space. They wanted to open malls, they wanted to open new stores, and despite a slowing economy, that did not stop. And that provided an element of tailwind for a lot of the landlords. Then secondly, the tailwind they had was that they had free access to capital because their share prices had done really well. They were trading at very expensive multiples, as we pointed to at the time, and they were able to go into the market and raise equity and just keep on buying more assets to drive their growth. And that was another tailwind. The third tailwind was that in terms of the leases and how the leases are set up in terms of sort of 5-year renegotiations, and you only have inflation plus type of escalations, and you only have positive rental reversions, which is saying your market value for that rental needs to go up, was the third tailwind that these businesses benefited from. And because of those tailwinds, they were able to run structurally higher debt. Because for as long as the party is going and you're growing, debt is not a problem. But when the party ends and you're sitting with too much debt, I think the model breaks down. And I think that's where we find ourselves in the property space now. It doesn't take a rocket scientist to figure out, with the amount of buildings that has gone up in the Sandton area over the last few years, there is significant oversupply within the office environment. Everyone's seeing what's happening with lockdown and the malls and what's happening to the retailers. It doesn't take a rocket scientist to figure out that the demand for space is going to reduce over time. And then thirdly, some of those structural challenges that we've seen from the online threat and e-commerce and what that does to brick and mortar that we've seen happen in the US and the UK and Europe, those trends are coming to South Africa. And therefore, your ability to continue in an environment where you've got excess vacancies, your rentals are probably higher than what they should be. You've got to renegotiate that to get the power shifting from the landlord back to the retailer to help them run a sustainable business. That cocktail, when you put it all together, is clearly, for me, negative for the SA property sector. So I think there's risk to distribution growth. I think there's risk to balance sheets. And I think thirdly, there are risks to asset values. And if you think your debt's not going anywhere and your asset values are likely to decline for the things we spoke about, ultimately there's a risk that that then needs to come back to the market in terms of having to get fresh capital, which would be dilutive. So while there's been a significant retracement in the property share prices, my only caution would be just because something has fallen a lot doesn't mean that it's cheap. And we've seen that time and time again. I mean, people said Intu was cheap at 50 Rand. They said it was cheap at 30 Rand. They said it was cheap at 20 Rand. I mean, at 2 Rand, they're still saying it's cheap. Just because something has fallen a lot does not mean it offers value. You need to go back to basics, keep it simple, and say what is being priced in by the market and what is this value for this business that ultimately I'm buying a stake in.
Absolutely. I just want to also get back to some of these questions. They're flying in, and I feel we're not giving them enough attention. So apologies to all, and hopefully we can answer most of them. Question: current market condition. Which are the companies at present? So they pressed enter obviously before they finished the question. So which of the companies at present that have a low gearing that are simply cheap due to current market conditions and sentiment? So do you have examples of companies that are, they're actually, so they're not heavily indebted, they got decent balance sheets, but they appear quite cheap?
Yeah, so I'll answer that sort of twofold. So I'll give the global answer and then come back to locally, because clearly I think the important message is that our view that high quality global equities are more attractive than SA equities, that remains the case. So our view that global is more attractive than local stands. And if you think through those high quality businesses that we think at this environment are still attractive, have got low levels of gearing, and is still able to grow through this environment. I mean, I would mention stocks like Visa, which I think is incredibly attractive, and we've been adding to in weakness. A stock like Microsoft that has still got significant runway for growth. A business like EA, which owns the FIFA franchise, that is growing through this, I think are just three names globally that spring to mind as stocks that we think have got low levels of leverage, defensive in this environment, still able to grow in the short term, but their longer term runway for growth actually looks more attractive post the economic recovery. Then locally, I would look at, in terms of where we're still finding value and where we're seeing some level of attraction for these high quality businesses from a local standpoint. So then maybe in South Africa, again, realizing that our quality universe is not as large as the global universe. I think where we are finding value is, for example, within the high quality banks. So there, for example, things like Capitec, things like First Rand, things like Standard Bank, where the valuations are reasonably attractive. These businesses are still well capitalized. Yes, they are more cyclical. So we're spending a lot of time around the cyclical risks around the economy and how we get out of lockdown. But standalone valuations are really attractive at this stage, and we think they still offer value. I mean, again, it's the one where if we then go into selectively some of the retailers, while we haven't bought them yet, they are starting to screen as something that is potentially starting to become more attractive. And there I would focus more on businesses like a Spar that is defensive, franchise model, that can still grow, that is still able to trade through that. So you are finding selective, I would call that your domestic Inc. Quality businesses. And then not to forget that we're still fortunate as South African investors to have access to global businesses that are listed in South Africa that can still grow. And there you would come through businesses like a Naspers that has got exposure to Tencent. You've got British American Tobacco that is very defensive in this environment, trading at a attractive valuation and can actually defend its dividend. So there are definitely stocks that we are finding listed in the South African market, stocks like, for example, Mondi, that is clearly attractive, yes, cyclical, but we think can still grow. So these are stocks in the portfolio that we've owned, and at lower valuations, we are actually adding to those names. And then importantly, there's a couple of names that's currently not in the portfolio that is actually on our short list and not too far away from making its way into the portfolio, which is different, which if you had spoken to me a year ago, and I would have said, is there a chance that I'm going to be adding to SA equities? The answer would have been most likely not, because we didn't find valuations attractive. Today, it's hard for me to say, based on the carnage we've seen in the market, that the market is ridiculously expensive and we're finding it difficult to find opportunities. Yes, there's still risk, which is why we're deploying our capital selectively, which is why we're still sitting with 23% of the portfolio in cash, is that it's not a slam dunk, but selective risk adding and risk appetite in a balanced portfolio, we think is the attractive place to be in this part of the cycle.
Mentioned Spar. I've got a Spar down the road from me, and it's amazing. Is it? You speak to friends, and they're struggling to get a couple of things. Our Spar's got absolutely everything. So it just shows that their supply chain, the supply chain and distribution is so efficient, so well run, that they are able to still stock their shelves with what people need. And the place, unfortunately, I say unfortunately, because it's busy. Probably too busy for the government would be so happy with it, but it is amazing.
It just goes back to that point of defensiveness, right? So you're going through, like, you don't find, we don't own any of the clothing retailers in the portfolio, right? So again, clearly that's discretionary spend. We acknowledge that there's still significant risk where you're finding some balance sheets that are maybe not as healthy as one would like. But you think through, again, a business like Spar, where people are still going to have to eat. They're still going to need to get their groceries. Great franchise model, super defensive. Post-lockdown, we've seen what's happened with people desire for alcohol. I mean, we know that Topps franchise that they own, while they're not able to sell today, obviously post-lockdown, I think there's going to be a clamoring for those sales. So again, those are the things we're thinking about, and we think investors should be thinking about when they're thinking about adding to positions.
No, so again, just to back to the questions, because I don't. So again, that's how they're flying in. Thoughts on Capitec? So again, from Andrew. And I mean, do you hold Capitec?
Yeah. So the answer is yes. So we own a little bit of Capitec directly. What we've actually found more attractive is PSG. So PSG is the holding company. There we've got, it's one of the top holdings in both the Opportunity Fund as well as the Cautious Managed portfolio. And there is what we like is clearly within PSG, we're finding it trading at a significant discount to the sum of its parts, its underlying assets. And those are underlying assets that we actually like. So Capitec, I think, is clearly one of the best run, well-managed banks in South Africa. We think there's still significant runway for growth for Capitec in terms of how it's been able to outfox the big four and grow in that low LSM space, but then also compete for the higher LSM customers by being more tech savvy. And there they've been able to take share, and our view is they'll continue to be able to take share. And it's been a bank that's actually been quite conservatively run, been conservative with the provisioning, and one that we actually like. We just find it cheaper to get access to Capitec via PSG. And then within PSG, the rest of their portfolio we think is attractive. Where you look at a business like Kuro with structural growth in terms of the education space, we find that attractive. And then for a business like Zeder, where now post the Pioneer sale has obviously got significant cash that will be helpful to the PSG from being able to pay a special dividend. And then you look at PSG Consult, which is another asset that they own that can benefit from the consolidation in the IFA space and in the market. So it's a business that clearly you then wrap it together with the management team at the PSG level that have proven themselves to be astute allocators of capital, gives us the confidence that this is a high quality business that we own in the portfolio in one of our top holdings in both cautious managed and in the opportunity fund.
Okay. So we'll get some stuff that's coming through. I mean, the long-term impact of COVID-19, the lockdown, kind of some themes coming through that you feel, and some themes will be short-term themes. There's no doubt about it. And actually so stocks will markets will kind of dip and they'll correct. Yeah. But there's just be some long-term themes also coming through.
Yeah. No, there's definitely long-term themes. But what I would caution is people extrapolating what we're experiencing now and assuming that will be the new norm. Because whether you watch Bloomberg, CNBC, all the chats that we all follow, Twitter, all this level of information that comes, there are all these great predictions being made about how the new world is never going to be the same than where we've come. And all I would say is, while there's an element of truth to some of those predictions, extrapolating all the trends is probably wrong. And I think there I will go back to lessons I learned during the global financial crisis, where people also made these great forecasts about how people were never going to have leverage again, and the market forgets, and people's memories are short, and life gets back to normal. And I think a personal one for me is probably, given my time in New York, I went there just after 9/11, and 9/11 was still fresh in people's memories, and people would say people would never want to work in a high-rise building again, and you'd never want to be downtown Manhattan, and you're never going to get on a plane again because people were just so scared. And while things did take time to recover, I think airline traffic, it took 3 years for passenger traffic to get back to 9/11 levels in the US. So it did take time, but things do recover and people forget and life goes on. And so there's going to be an element of returning to normal. So yes, there's a short-term impact. Yes, it's maybe going to take us a little bit longer to recover to life as we knew it, but people will forget and people will move on, as we've seen in the number of cycles that we've lived through over the last few years. But the last point I would make is that there are clearly some structural trends that are happening. And what we've seen with COVID-19 has actually accelerated those, and I think makes those longer term, trends that I think are now being reinforced and very difficult to pull back. And there I would say it's the trend for e-commerce. I think that will continue to accelerate. And what that then means for traditional brick and mortar retail, I think has got significant questions that need to be answered. So we remain quite negative on the outlook for traditional brick and mortar retail and ones that we think about carefully. And therefore we think those trends of e-commerce as one where those trends will continue, and getting exposed to businesses that benefit from e-commerce as one where investors can actually make quite a bit of money. And then the second trend that I think is with us is digitization, where we're seeing through the COVID-19 epidemic, both locally and globally, for businesses that we follow, is that businesses that are set up to operate in this digital world that can operate and thrive remotely are actually getting stronger. So we're seeing it in the example, in the cases of the likes of a Nike, of an Estee Lauder, which is global health and beauty, that have got strong e-commerce online platforms, that in this environment, they are actually able to accelerate sales growth and take market share and those businesses are actually thriving. Whereas businesses that have been slow in terms of digitizing their businesses are actually finding that they're losing out and they're losing market share and finding it hard to adjust. So those trends are with us. And I think if you are positioned in the right space, you can actually make good money. And if you are positioned wrongly, I think you're going to be sitting on a bit of a melting ice cube where the business fundamentals continue to erode. And while you potentially might look, you're owning a cheap asset, that cheap asset just continues to deteriorate and ends up being a value trap.
You mentioned airlines. I got a comment and then a question. As one is the comment is, I don't know if people saw the Richard Branson's asking for both his Virgin Atlantic Airlines, I think in the UK and then obviously in Australia, to kind of to be bailed out or helped out as such, which is, and I know he's been taking a lot of flack for asking, because I think he also asked his workers at one stage not to take salaries for a period of time. You know, he's got X amount of billions in the bank. And that's, which is, so again, I think some of these guys will be very careful with their kind of public profiles and then actually their business interests. And then the other thing is SAA. I mean, is this the end of the road for SAA?
Yeah, for us, it's very difficult to tell. Clearly you can never sort of bet against government doing maybe something irrational. But if you're going to try and keep things simple and sort of take the politics out of it, it's very hard to conclude for a business person that this business is solvent and that the financial model works, because basically when they were operating, every flight they're taking, they're basically just losing more money. We know as business people, as people that are exposed to the financial world, that is just not sustainable. Governments clearly taken a tough stance and said this is not sustainable. And they're drawing a line in the sand and saying that they're not prepared to support them at this stage. So it looks like, for now, that looks like the end of SAA. But I've always said that you can't write off politics. And SAA has got a number of staff, and we know government doesn't like job losses. And therefore, there's a risk that government capitulates and somehow saves SAA. But for what we've said for a number of years now is that SAA is actually not the problem. SAA is small fry compared to what is the real problem, which is Eskom. And I think government, in all our engagements with government and the different ministers within Treasury, they realize that the battle is actually Eskom. And if you fold on SAA, you've got no chance on Eskom. And Eskom is the nut they're going to have to crack. So I think the hope at this stage, if they show that they're hardball on SAA, that they can get Eskom to the party and make the tough choices on Eskom, which this country desperately needs. And if we see that happening, I think despite all the turmoil that we're seeing in the country and why it's so negative at the moment from a psyche, I think that will actually be quite positive. And I think the one lesson I've learned from living abroad is South Africans are naturally pessimistic. And from having lived in different countries, I've realized that the grass is not always greener on the other side. And every country has its challenges. And South Africa clearly has got significant challenges. So while I think government is trying to do the right thing, if they are able to land it, despite the skepticism, I think it would actually be quite positive for this country, which I think as citizens of this country, as people who live here, who raise our families here, we should certainly be rooting for them in terms of being able to land this.
Yeah, it's a funny one also for me, is it sort of national pride having your own airline, and it's an emotional connection, even though it's not run very well. A question from David, wealth tax. According to Bloomberg, there was talk about this once off with specific reference for COVID-19. Have you heard anything? I mean, there was also talk about this in the budget speech, just for the budget speech, I think it was. Has there been any further noise on this?
Yeah, so I mean, again, in terms of the context we had, so clearly we do a lot of work around the budget, what's happening with the budget, engagement with our different contexts within government to see what's coming down the pipe, what they're thinking about, and then engaging afterwards. So the one message that's become clear is despite all the talk around the wealth tax, the feedback we got from our different government officials that we engaged with after the budget speech was that they realized that there was very little scope for them to attack the wealth tax because, again, you don't want to kill the goose that's laying the golden eggs, and you realize that the wealthy have taken a significant hit in this economy, and one where you didn't want to add that additional burden. So that was one where that was actually a positive message, and despite all the skepticism in the market, I think government realizing that there's only so much that they can do before they sort of break the camel's back. What has happened subsequently is clearly what has happened with COVID-19 has clearly been an exceptional circumstance where there's been significant drain on the fiscus. Yeah. And the question that everyone is asking is, how are we going to all pay for this? And as we come out of COVID-19, as we try and get the economy back in, as we try and pay all these bills that have become due, how do you fund that? And from what we understand, I mean, we've seen the rumoring around the wealth tax. I mean, clearly that is not just noise. I think from our intel, it's clearly that is being bandied about. And the thinking being is that, again, it's going to be about getting revenue and getting access to revenue. And what is the level of revenue that government can do that can actually move the needle? And the reality is there's only one thing that's going to move the needle, and that's VAT. And politically, to go with VAT at this stage without having some element of where where you seem to have within the poorer communities have given the wealthy a pass in the budget by not tackling a lot of the things that we had feared in terms of wealth tax, increases in sort of like exchange controls and the like. If you gave them a pass now, if you're going to be tackling VAT, which is politically super sensitive, the poorer communities are going to see that the wealthy is going to have to be having to chip in a little bit. And I think that's where the thinking at the moment is about toying and about the wealth tax. I think in terms of our intel and what we've been feeding back is that clearly this is a very sensitive time to be doing it, and just to be very mindful about the risk of what that adds. And maybe even when it comes to the VAT issue, again, maybe not the right time to be bringing it up as people are just trying to find their feet. So don't try and deal with the tax revenue things up front, given the sensitivity of it. But unfortunately, those are realities, and the message we're giving back to our stakeholders is that it needs to be done in a format that is obviously conducive to market participants, that is well understood, and again, in line with historic government policy, where it's one where it's understood, market understand what needs to happen, and ultimately people, if they understand the rules of the game, it's something they can move forward with. This is not going to be a quasi just the only place we're going to go is to essentially tackle the wealthy, and they're the only ones who are going to carry the burden. This is clearly where this is not coming from. So that's the level of comfort I can give.
It's interesting. I think, and unfortunately, as you say, the big kind of needle mover is VAT, and that affects all, which is and I think it's quite scathing is whilst we're in lockdown, is we don't actually realize what's happening outside there in that some of the other communities. We see it in the news and the press, but we don't actually understand how hard this is impacting some people kind of in some of those kind of poorer communities.
Yeah, I mean that is an important point you make. So I mean, again, it's the feedback that we've been getting through the different channel checks we're doing. So while each of us would have individual stories of friends or relatives that are going through incredibly tough periods now, with either they've been retrenched or they're getting no cash flow, they're not getting paid, they don't actually know where their next meal is going to come from. We all have those anecdotal stories. I can say from our larger intel, as clearly there are significant shots being taken in the economy and cash flow is poor, which is why when in my address to clients is one where I've continued to exercise caution, where despite this bear market rally that we've seen off the lows, I've said, listen here, we are not through the worst. This is not the time to be deploying all your capital into risk assets, because there's still a risk that the recovery is going to be slower than people anticipated. It's going to be maybe longer than people had anticipated. And it's not going to be the sharp V recovery that people are pricing into the market at this stage. So while valuations are more attractive, I think there's still risks, and you don't want to forego that flexibility, that you've got enough firepower to be able to take advantage of those opportunities when they come over the next few months.
So Duane, I think that's it from us. It's 2 minutes to 12, and we've had an hour. It's amazing how quickly the hour actually goes. I mean, first of all, thank you to yourself for joining us. Really do appreciate it. And thank you to the participants for engaging and asking lots of good questions. Sorry we couldn't get through to all of them. We do appreciate that. So a couple of things just before we close. A reminder of the CPD process. So all participants will get a thank you emailer. In the mailer will be an assessment which you complete for your CPD points, where you half a CPD point. The presentation, there will be some slide pack to kind of back up what we were talking about today, will also be in there. Try to think, looking at my notes if I've forgotten anything. Often do. And then I think our next webinar is in May, and it's with Schroders, so a global asset manager. So that also maybe get a slightly different take in terms of what's going on. Otherwise, I think that's all. Duane, thanks again. Really do appreciate it. And thanks to everyone for joining us. Okay. Cheers.
Awesome. Thanks for having me. All the best.
Good man.